Good morning, venture capital. This is Metagame, and today's episode is about how artificial intelligence is fundamentally reshaping the investment landscape as it crashes headfirst into the world of venture capital, forcing everyone to tear up the old rulebook and write a completely new one. 5 deals. That's all it took to make Q1 2026 look like the greatest quarter in venture capital history. $267 billion in deal value. Headlines everywhere celebrating the comeback. VCs popping champagne, LPs nodding approvingly at their quarterly statements. But here's what nobody's talking about. Remove those 5 transactions, and the entire narrative collapses. The quarter doesn't just look weaker, it looks like a market in retreat. So which is it? Are we witnessing a venture renaissance, or are we watching capital consolidate into a handful of winners while everyone else fights for table scraps? By the end of this, you'll know exactly which side of that divide you're standing on. Let's start with the number that should keep traditional VCs up at night: 69%. That's how much capital flowed into billion-dollar-plus deals in the back half of last year. Not half, not a majority. Nearly 7 out of every $10 went to companies raising at unicorn-plus valuations. Meanwhile, deal count actually ticked up 2%, while total capital dropped almost 6%. Do the math. More companies launching, smaller checks being written, and a shrinking pool getting fought over by everyone who isn't Databricks or X.AI. Speaking of which, let's talk about what normal fundraising looks like now for the elite tier. Databricks pulled in $5.7 billion across multiple tranches in 6 months. X.AI, yes, Elon's AI play, raised $5.3 billion in a single round. Synopsys grabbed $2 billion. These aren't Series A rounds. These aren't even traditional growth equity checks. These are capital formation events that dwarf entire venture funds. When a single company raises more than most firms deploy in a decade, you're not operating in the same market anymore. You're watching 2 parallel universes drift further apart. Here's where it gets interesting. While traditional venture is consolidating into this barbell, mega rounds at the top, seed deals at the bottom, and a disappearing middle, there's one category that's completely ignoring the macro anxiety: enterprise AI budgets. KPMG just dropped their March Global AI Pulse, and the number that matters is 74%. That's the share of enterprise leaders who say AI remains a top investment priority even if recession hits. Not will consider it, not will evaluate. 74% say they're not cutting AI spending, regardless of what happens to the broader economy. And these aren't hypothetical commitments. The weighted global average for planned AI investment over the next 12 months hit $186 million per organization. That's not venture capital speculation. That's Fortune 500 operating budgets voting with real dollars. When 3/4 of decision makers tell you AI survives a downturn while marketing and traditional IT gets slashed, you're looking at a category that's achieved mission-critical status. It's not a nice-to-have anymore. It's infrastructure. Now, why does this matter for VCs? Because the hyperscalers are underwriting this entire thesis with their own balance sheets. Amazon's CapEx plan for this year, roughly $200 billion. Alphabet, $175 to $185 billion. Meta, $115 to $135 billion. Microsoft's implied run rate, around $145 billion. Added up, that's $650 billion in combined spending, explicitly justified around AI infrastructure, data centers, GPUs, networking, training, compute. For context, that single-year CapEx commitment exceeds total U.S. venture deployment in most years. The largest companies on Earth are betting their futures on AI demand that's already contracted and growing. VCs investing in the picks and shovels plays, compute optimization, ML ops, inference efficiency, are riding a wave underwritten by the biggest balance sheets on the planet. So the market has bifurcated. On one side, you've got AI infrastructure and applications serving enterprise demand that's hardening, not softening. 26% of organizations already have AI agents in production. That number's climbing fast. On the other side, you've got traditional B2B SaaS without clear AI differentiation, facing multiple compression risks, revenue comparisons against AI native competitors, valuation multiple contraction, talent flight to better funded AI startups. The middle market isn't just shrinking, it's getting compressed between these 2 forces. Let me paint you a picture of what this looks like in practice. The SEC Form D filings from Q3 and Q4 last year read like a tale of 2 cities. At the top, Databricks, X.AI, Synopsys, Genesis with $1.5 billion. These are companies raising at multi-billion-dollar valuations with established revenue or strategic scarcity. At the other end, dozens of sub-100 million raises fighting for attention, Nomos AI at 103 million, High Note Platform at 109, Swim Lane at 143. The missing middle, Series B and C rounds in the 50 to 250 million range. Once the bread and butter of growth equity is compressing as LPs consolidate into fewer, larger funds, and those funds concentrate checks into proven performers or AI-specific theses. This creates a strategic inflection point that every VC needs to confront honestly. First question, where does your portfolio sit on the AI barbell? If you're concentrated in traditional software without clear AI differentiation, your next funding round is happening in a more competitive, lower price environment, unless you're in one of the handful of hot categories. Second question, can you credibly compete for mega rounds, or should you reposition entirely? If your fund size and LP base can't support writing $50 to $100 million checks in later rounds, you risk getting diluted out of your winners or being forced to sell early. The alternative is moving downstream into pre-seed and seed, where more companies are launching, but you'd better bring a differentiated sourcing edge. Third question, and this one's crucial. Are you positioned for the infrastructure cycle? That $650 billion in hyperscaler capex isn't equally distributed. It's concentrated in GPUs, data centers, power infrastructure, and networking. Second-order opportunities abound. Companies optimizing inference costs, building AI-specific observability tools, securing AI supply chains, enabling edge deployment. These picks and shovels plays often raise smaller rounds, but serve non-discretionary demand from hyperscalers and enterprises that have already committed capital. The gravest risk right now is sitting in the middle, neither large enough to compete for mega rounds, nor nimble enough to dominate pre-seed. Neither AI-focused enough to ride enterprise budget expansion, nor defensible enough in non-AI categories to withstand competitive pressure. The 69% concentration statistic means the middle market is shrinking as a percentage of total deployment. Funds that don't explicitly choose a side will find themselves squeezed on both deployment pace and returns. But here's the thing about consolidation, it creates white space for those paying attention. Vertical AI applications in sectors with regulatory moats or data advantages, healthcare, legal, financial services, places where incumbents can't easily pivot and AI natives can build defensible data flywheels. AI tooling for the long tail of enterprises, that 74% who say AI is recession-proof aren't all Fortune 500. Mid-market companies need simpler, cheaper AI deployment tools. Infrastructure plays enabling multi-cloud or hybrid AI as enterprises diversify away from single hyperscaler dependency. So let's close the loop. Remember those 5 deals that made Q1 look like a triumph? They're not an anomaly. They're the new reality. The market isn't recovering uniformly, it's concentrating violently. $267 billion in headline numbers, but the underlying structure has fundamentally shifted. Capital is flowing to AI infrastructure and applications serving enterprise demand that 74% of leaders call recession-proof. It's flowing to mega rounds that dwarf entire fund sizes, and it's flowing away from the traditional middle market that defined venture capital for decades. The question isn't whether this bifurcation is happening. The data's already settled that debate. The question is whether you're positioned on the right side of it. Are you riding the $650 billion infrastructure wave? Or are you fighting over a shrinking pool with everyone else? Are you building conviction in AI verticals where enterprise budgets are hardening? Or are you hoping traditional SaaS multiples somehow recover? 5 deals swung the entire market's narrative. 5 deals. That's not diversification. That's not a healthy ecosystem. That's a market telling you exactly where the future is being built and where it isn't. The firms that recognize this bifurcation and adjust their deployment strategy will capture the next cycle. Everyone else, they'll be reading about it in the headlines, wondering how 5 deals changed everything while they were looking somewhere else. That's our Venture Capital podcast for today. If you learned something new, tap 5 stars and follow our show. Thank you for listening to Metagame.
Grep News. Thomas.